Yes, inaction, being on the NPC and doing nothing. That was sort of, see, I like this quote. There's some, and it's not quite clear who said it first. I'll come back to who I think said it first and the context in which they said it in a while. It's not a bad piece of advice, actually. So when I became a member of the Monetary Policy Committee, that was in May of 2009, so a bit over 6 years ago, interest rates had just been cut to 0.5% in March, a couple of months before I joined. They just started asset purchases. And it seemed at that point, when I joined the committee, extremely unlikely that interest rates would remain at this sort of emergency setting for very long. And I don't think many people expected that asset purchases would actually go very much further than where they got to by May. From memory, I think £75 billion of assets have been purchased by the time I joined the committee. And I think it's fair to say, I mean, Kate Barker maybe will reflect on this in her comments. She had been on the committee for a while at that point. But I think it's fair to say that no one on the committee really at that point, mid-2009, would have thought it, frankly, even remotely likely that 6 years later, the middle of 2015, the following would be true. Firstly, the bank rate would still be at 0.5%. Secondly, that if you looked at where financial markets were, in a sense, pricing where they thought bank rate would be even 3 years down the road, that's kind of the middle of 2018, that would be barely 1.5%, maybe a little bit more than 1.5%. I don't think anybody thought that asset purchases 6 and a bit years later would have added up to 375 billion, and that none of those would have been sold. And that finally, with all those things in place, that the inflation rate would be 0, which is where it is right now. And I think all of this, in many ways, is a sign of the enormous and really long-lasting disruption that came about after the financial crisis, which really reached its worst in the autumn of 2008. And in some way, I think it's too early to be looking for any kind of epitaph for the financial crisis. But if I had to settle on one today, I think it would be the one that was first used about Christopher Wren, which is Si monumentum require circumspice, which is, if you're looking for my monument, just look around you. And what would you see if you looked around you in the UK right now? Well, what you'd see, first of all, is a level of economic activity that's about 15% lower, GDP, 15% lower, than the trend that the economy appeared to be on in the period leading up to the financial crisis. So that's where we are 6 and a bit years later. A level of productivity that's also about 15% lower than what appeared to be the relatively steady trend the UK economy was on. A level of real wages which are probably more than 15% lower than the trend they seem to be on. Probably that's nearer 20% lower. And you'd also see a rate of inflation that was really rather a long way by historical standards, by the standards of the MPC's performance. A rate of inflation was really a long way away from our target. Though it seems to me that on that last point, on the rate of inflation, it seems to me really not very difficult to understand why the inflation rate is so low right now. It's largely a reflection of some big falls in commodity prices, oil in particular, about a year or so ago, rolling through the system, and also some appreciation in sterling. And it seems to me really rather likely that if you go ahead 6 months or so, really we'll be on a trajectory with inflation moving back up to the target. I think that is quite likely. So the undershoot of inflation in some ways is relatively benign because it's actually brought about an increase in purchasing power. It's not that difficult to understand, and I think it is very likely to be temporary. And none of those things, easy to understand, relatively benign, likely to be temporary, none of those things are true of the undershoot of GDP or of productivity or of real wages from the trends that they were on. And I think that is a reflection of the enormous disruption to activity that that financial crisis that happened a few months before I joined the committee brought in its wake. And really it's why I think we've needed an extraordinarily expansionary monetary policy in the period since I joined the committee. And as you rightly know, that expansionary monetary policy was to a large extent, not completely, but to a large extent put in place by the end of 2009, when I think we bought £200 billion, so 200 billion of the £375 billion of assets had been bought by the end of 2009. Bank rate had been at 0.5% for 9 months or so by the time we got to the end of 2009. So to a significant extent, the very expansionary monetary policy was indeed put in place by then. And up until our meeting of some weeks ago, I have not yet voted for a single change in bank rate. And I mean, it is a sort of potential source of embarrassment. In some ways, people might ask me in future, what did you do when you were on the Monetary Policy Committee? Now, I could say, well, I voted for hundreds of billions of asset purchases, so not exactly nothing. But actually, I think a better answer to that question would be that I heeded a good piece of advice, which is, don't just do something, stand there. That's a quote. I think Peter Ustinov said that first, and I'll tell you why he said it in a minute. The bit I've added is ... and think. Peter Ustinov, I believe, may have been the first person to say it. He said it because he got rather fed up with young actors, stage actors, in the I suppose it was late 1950s and early 1960s, who had been much influenced by the sort of method school of acting, which meant that even though they might have a very small part in a stage play, they thought they ought to do things and be sort of hyperactive. And Peter Ustinov said, don't just do something, stand there. You've only got 2 lines. And now, actually, I do have one more meeting on the committee, and it will coincide with the MPC's August inflation report. And it does come at a time when I think the case for beginning a gradual process of what you might call normalisation in the stance of monetary policy. I think the case for starting that is stronger now than at any time that I've been on the committee. And maybe I'll come back to that a little bit later. But first I want to step back just for a moment and perhaps reflect on some of the lessons we should take about central bank policy from what's happened over the last 6 years, or at least the period since the financial crisis at the end of 2008. And then I'll come back with a few comments at the end as to what I think we should do next. So, let me move on a little bit. So when you look back at the sort of great damage that was done by the financial crisis, much of which has proved very persistent damage, I think you could ask yourself, what are the ways in which you could try and ensure that this will not happen again, or at least reduce the probability that this kind of mess happens again. So you could think of doing 2 things, and they are not mutually exclusive, and I think it makes sense to think about both of them. So firstly, you could try and increase the scope to use monetary and fiscal policy to offset the after effects of a financial crisis. So you kind of accept that financial crises are going to come along, and you just try and make sure that then, after they've happened, you've got lots of scope to use monetary and fiscal policy to try and offset their impact. The second thing you can do is try and reduce the chances of financial crises happening in the first place. And I'm going to argue that the benefits of strategy 2 are now likely to be much larger than the benefits of 1. Partly because, actually, I think we did have here in the UK, not just in the UK and in many countries, it turned out that there was actually rather a large scope to use monetary and fiscal policy. The fiscal deficit, of course, did rise enormously, and the so-called automatic fiscal stabilisers in the UK were allowed to work. I mean, that's one reason why the deficit has come down much less rapidly than might have been expected, because the recovery has been weaker and didn't start until much later than had been thought, and those automatic fiscal stabilisers were to a large extent allowed to work. And I think there has been great scope to use monetary policy, and I think it clearly went beyond simply taking bank rate to close to its effective floor of 0.5% or so back in March 2009. Actually, that wasn't the end of the story. £375 billion of asset purchases. And not just that, actually, a rather significant increase in the ways in which the Bank of England can make liquidity available to the banking sector in stressed conditions, part of which was the launch of the Funding for Lending scheme, which was in September, the middle of 2012. And I think the fairly steady and ultimately very large fall in the interest rates that really matter in the economy, and that's not Bank of England bank rate. The rates that really matter in the economy, the rates at which companies can borrow, the rates at which households can borrow on mortgages, on unsecured credit, those rates gradually have come down very substantially. But it was really rather a long time between the big reduction in bank rate and those other rates falling, and I believe that the asset purchases, the Funding for Lending scheme, the greater availability of liquidity from the Bank of England were what made those other interest rates that really matter then slowly, but only slowly, begin to fall in the aftermath of the easy bit for us on the Monetary Policy Committee, which was actually cutting bank rate. So let me show you just a few pictures of what happened to some of these rates that really matter in the economy. So the green line here is sterling investment grade private non-financial corporate bond yield, a bit of a mouthful. It's kind of the interest rate at which companies that can borrow in the bond market will borrow in sterling can borrow at, and that's been on a sort of gradual downward path, but a fairly gradual one really, and it's taken several years to come back to or come down to very low levels. Much the same is true if you look at the mortgage market, where there's clearly a very substantial lag between the cutting bank rate and then the kind of interest rates that matter, rates on fixed rate mortgages 2 and 5 years, or various different loan to value ratios. And I do believe that it was the side effect, the intended effect of asset purchases and then later the Funding for Lending scheme to allow that reduction in the interest rates that really affect the behaviour of households and companies in the UK. I think it's because we had substantial scope to use monetary policy even after we'd sort of run out of room or close to run out of room on bank rate. Because we had that scope to do that, I think sometimes economists can overemphasize the extent to which you kind of run out of room, run out of ammunition, when the policy rate that the central bank can set gets very close to zero. Because there are other things that central banks can do. There are certainly things that we did on the Monetary Policy Committee. And I think that is actually relevant when you consider one of the recommendations that some economists have for how you give yourself scope to deal with things like a financial crisis in future. So there is an argument put forward by very eminent economists. There is an argument which goes like this. It says, look, if you have an inflation target of 2%, maybe in ordinary times you set the interest rate as a central bank a few percentage points above that, call it 5. If you then run into a crisis, you may want to cut interest rates by substantially more than 5%. And if you run into the zero lower bound, then you're stuck. Now, how do you avoid that? Well, one way you might avoid it is say, well, don't have a 2% inflation target, have a 3% inflation, have a 5% inflation target, so that on average, the level of interest rates you'd want to set at a central bank wouldn't be a couple of percentage points above 2, it would be a couple of percentage points above 5, call it 7 or 8. If 8 is normal, then you've got 8% to cut interest rates before you hit the zero lower bound. So that's one thing you might want to think about doing. And that argument seems to me not a very powerful one if you believe, as I do, that there are other things that central banks can do, and we did do in the Bank of England, even once we got to close to zero on the level of bank rate. And because of that, I think the case for saying we should now increase the inflation target is actually rather a weak one. Now, I'm not saying that there aren't any advantages to thinking about ways in which you could increase the scope to use monetary and fiscal policy when you get hit by the next crisis. There will be another crisis at some point. But I would argue that there are some pretty powerful reasons for thinking that the second of my two responses, which is can you reduce directly the probability of financial crises happening in the first place, that is likely to bring you far more benefits than trying at the margin to increase your scope to deal with the aftermath of a financial crisis when it comes along. And part of the reason for saying that is that it seems to me the most direct way that you can reduce the chances of the kind of mess we got into in 2008 happening again is by changing the funding structure of some of our largest financial institutions, in particular reducing the leverage or increasing the equity funding, which is the same thing, of banks. And I think that directly deals with the problem that we got into in 2008, which was that once people began to doubt what the value of the assets of some of these financial institutions was, they had such a large amount of debt and so little equity that the equity was used up, in a sense. That buffer was used up as soon as you thought that the value of the assets might be just a few percentage points low. If you have a financial institution that's got 2% equity funding and 98% debt, you only have to think that the assets have fallen in value by 2% before you've used up the equity and there isn't enough value left to cover all the debt. So you get into problems of perceptions of insolvency very, very quickly when leverage is so very high. So I think that a far better strategy in dealing with the crisis and trying to reduce the chances of that kind of damage happening again is to think about the funding structure of the financial institutions rather than say, well, how can we increase the scope to move bank rate around when we get inevitably the next financial crisis. And part of the reason for saying that is that actually I believe that the costs of asking financial institutions to use more equity than they used to and rather less debt, the costs of that are actually quite small. And I want to very quickly, in just a few minutes, run through a very simple calculation to illustrate that point. Suppose you start in a world, I've called this Corporate Finance 101, introductory bit of economics. You teach finance students for thinking about the cost of funding for an institution. Suppose you start out in a world in which financial institutions, think of it as a bank, have a bunch of assets, and only 2.5% of those assets are funded with equity. So 97.5% is funded with debt. And let's assume that we're pre-crisis, we're in a nice period, 2006, 2007 in the UK, the average level of interest rates is about 5%, so that banks can raise debt and pay about 5% on it, but if they use equity, which is much more risky from the point of view of people providing equity funds, they need to give an expected return to the people that provide equity funding that's a lot higher than 5. Let's say it's 15%, very much higher than 5. So we start out in a world in which there's a little bit of equity, there's a lot of debt. What's the weighted average cost of the funds of the institution? Well, it's just the weighted average of 5 and 15, with a very large weight on 5 and a really rather small weight on 15, and that adds up to about 5.25%. So that'd be the cost of funds. So supposing that the bank either decides itself, or the regulator says you have to, double the amount of equity funding. So that goes from 2.5% to 5% of your funding. You have to replace some debt with some equity. What would happen to the cost of funds? Well, if there's no change at all to the required rate of return on equity and debt, that cost of funds will go from 5.25 to 5.5, 1/4 of 1%. That's halving the leverage ratio. That's halving leverage from 40, which is just 1 divided by 0.025, to 20. So you've halved leverage, you've doubled the amount of equity. Has this devastated the commercial viability of the institution? I don't think so. You've gone from a cost of funds of 5.25 to 5.5. That's 25 basis points. In the old days, people used to think of that as the kind of thing the Bank of England would do from 1 month to the next quite routinely, 25 basis points. We didn't think capitalism would end. Actually, and I won't go into too many details on this right now, there are some pretty good reasons for thinking that the actual increase in the cost of funding to a bank might well be lower than that, because after all, if an institution has become more robust, become less likely to become insolvent as a result of having more equity, both the debt and the equity are slightly safer. So you might actually expect that those two numbers, 5% required return on debt, 15 on equity, actually themselves come down a little bit. In fact, if you take that argument to its limit, kind of well-known theorem in corporate finance, the Modigliani-Miller theorem, would tell you that there should be virtually no change in the cost of debt to the bank. Now, I don't really believe that this Modigliani-Miller thing really works in the real world, but even if you take the pessimistic view, I'm about to kick the screen over. Even if you took the pessimistic view, I mean, you are talking about quite a small increase in the overall cost of funding of financial intermediaries from really rather a big change in their use of equity and a very substantial fall in leverage, a halving in leverage. And that's one reason why I think the better way forward, when you stand back and look at the lessons from this financial mess, the crisis that we got into and the costs that came after it, a better way forward than trying to give the central bank more scope to move interest rates, say by increasing the inflation target. A far better way is actually to change the funding structure of financial intermediaries and banks in particular. And in fact, that is the road that I think we've gone down in the UK. We've seen some pretty large increases in the capital or the equity funding of banks. In fact, on some metrics, on some calculations, that's gone up tenfold. Because it's gone up tenfold from what was, I think, with the benefit of hindsight, an extraordinarily low level of equity funding. And it may well be that even though the amount of equity funding of the banks is much higher now than it was, possibly as much as 10 times higher, since you were starting from such a low level, it's not obvious that you've it's on the Monetary Policy Committee. So let me think a bit more now about the lessons specifically about monetary policy from what we've been through, and then finally offer some thoughts on where we might be going next. As I mentioned earlier, I don't think we did run out of ammunition when bank rate reached very close to its effective lower bound. And there were other things we did do, and I think they turned out to be quite effective. Incidentally, that wasn't the message from much of macroeconomic theory. Many theoretical models in economics would say that the only thing a central bank can really do is cut interest rates. And when it's cut them, the only thing it can do beyond that, and it reaches a lower level that it can't go beneath, is just try to affect people's expectations about how long they will keep them at this very low level. And there was a degree, and still is a degree, of skepticism about whether things like asset purchases, which we embarked on a very large scale, I've mentioned the number 375 billion many times, it's an astonishingly large number. There was a great deal of skepticism about whether that would do any good. I must say that I very much find myself in the same position as Ben Bernanke, formerly chairman of the Fed in the US, who said of asset purchases, or QE, quantitative easing, he said the problem with QE is that it works in practice but it doesn't work in theory. And I think there's something to be said for that. And if you look back at those charts that I showed you earlier, which really show very sharp fall in bank rate here in the UK, but then only a very gradual reduction in the interest rates that really matter in the economy following after that. I think that's one indirect indication of Bernanke's thought, that it seems to sort of work in practice, although we don't quite, as economists, have a cast iron economic model that tells you exactly why it worked. One thing that I doubt very much has been the case is that when central banks get close to this lower bound on the interest rate that they can set, that the economy then becomes very unstable. I don't think there's much evidence for that, although many economists were extremely concerned, and many still are in the UK, with our zero inflation rate. And actually inflation, because it was negative, slightly negative, a couple of months back. Some people do worry that when you get close to this position, inflation itself close to zero, and the interest rate that the central bank can set close to its lower limit, that really the risks become very substantial of careering off into ever-falling prices, to get trapped in a deflationary spiral as people become used to the idea that inflation may be very low and even turn negative, and therefore postpone purchases because they think I might as well wait 6 months or a year because things will be cheaper. In principle, in theory, that is something that one should worry about. In practice, I don't think there's an awful lot of evidence, although you hear people still saying this is a real worry. I don't think there is a lot of evidence that actually this happened. I want to give you some very... let me give you bits of evidence as to why I think this risk has been overstated by many people. Okay, this rather busy chart shows expectations, forecasters, people in financial markets, economists working in government institutions and such, forecasts of where, in different countries, people thought inflation would be, and I've taken it relative to the average of those forecasts before the financial crisis. So 2003-2007 is a period where things seem to be going okay in most of these countries, and here's a chart showing you what happened to people's expectations of inflation. Here's the financial mess, back end of 2008, around about there. Initially, there's a very significant fall in those expectations of where inflation might go. But actually, within 9-12 months, within a year, say, most of those lines, for most of those countries, are pretty close, slightly beneath, but not very much beneath, the 0 point. And the 0 point says that people's expectations then were not dissimilar for where inflation would go relative to the average from a rather benign period, 2003-2007. This chart makes a kind of similar point in a slightly different way. This is looking at slightly longer term expectations of inflation. So this is where people who were making forecasts at the time thought that the average rate of inflation would be over a 5-year period, starting 5 years ahead. So if people had really thought that central banks had become powerless in the wake of this recession, and after they cut interest rates to close to zero, in heading off deflation, i.e. ever falling prices, I think you would have expected these lines here, each line for a different country, to have actually fallen to extremely low levels and never come back up. Now it did happen in some countries. Switzerland, is that green line there, and that did really stay down at very low levels. But if you look at the rest of the countries, those lines are bunched around, even if you look right around the time of the financial crash and in the years after it, those lines are bunched around about 2%. So there did not seem to be a general belief that inflation would move to negative levels and stay there for a protracted period. Final chart on this point before I briefly talk a little bit about where we might go next. Final point on this chart. Okay, what is this line? What does this show? This is an estimate of the probability that in financial markets people seem to be attaching to negative inflation. It's backed out of option prices. The US and the UK are the blue lines. That did move up really very significantly around the time of the financial crisis right back here. But then since then it's hovered around 5-10% level. It's about 10% in the UK right now. So even though the current inflation rate in the UK is 0, has been marginally negative just a month or so ago, there doesn't seem to be a widespread belief, at least in financial markets, that there is a very high probability we get trapped into negative inflation for a sustained period. Let me conclude by looking forward a little bit about where we might be heading in terms of monetary policy. Well, we've set in the Bank of England what you could call an uber expansionary monetary policy. And the question now, I think, for the Monetary Policy Committee, the main question I will be thinking about in my remaining time, is how long should we keep this very expansionary monetary policy in place? In an environment where increasingly the economic news, at least from within the UK, has been really rather favourable. The unemployment rate's about 5.5%, maybe very slightly beneath it. For several quarters now, more than just a few months, for several quarters, the rate of growth of GDP has been not far off an annualised rate of 3%. It's probably above the long-run average rate of growth of GDP in the UK. Consumer business confidence is relatively high, and it's been rising for some time, and very recently wages have begun to increase. The inflation rate, of course, remains significantly below our target level of 2%, but we think we understand that reasonably well, and it does seem to me highly likely that starting in a few months' time toward the end of this year, actually the inflation rate is likely to move up fairly sharply back towards the target level. So the question is, where should we be heading in terms of monetary policy, and specifically where should we be heading in terms of bank rate? Well, it seems to me that there's a good reason to believe that wherever we're ultimately heading, it is likely to be to a level of bank rate that is lower than what we used to think of as normal. What do we mean by normal? Well, if you take the 321 years since the Bank of England was established in 1694, the average level of bank rate over that whole period is almost exactly 5%. It's at 4.9. If you take the much shorter, more relevant, more recent period, 1997 to 2007, a period when the Monetary Policy Committee managed to get, inflation pretty close to the target level of 2% all the time, bank rate also averaged pretty close to 5%, maybe very slightly under 5%. I think there are some pretty good reasons why we shouldn't expect bank rate to get back to that kind of level over the next few years, even if the economy is beginning to operate in a relatively normal way. And let me just mention some factors and actually try to quantify some of these factors to come up with what you might call a back-of-the-envelope educated guess as to where the level of bank rate that might be normal might be in the future. And I think it is lower than the old normal, which is probably close to 5%. Let me mention a few factors. One, higher credit spreads. What does that mean? Well, it's pretty likely that the compensation for risk people need in order to buy corporate bonds or for banks to lend money to corporates or indeed to households, the spread, the risk premium in some sense, between the rate of interest they charge and the rate of interest that the central bank sets, bank rate here in the UK, that spread is likely to be bigger than it was in the years leading up to the financial crisis, when it had been squeezed to extraordinarily low levels. We've tried to quantify this in the Bank of England. For what it's worth, I think that might be worth about 75 basis points, 0.75%. In other words, what that means is that, if that's right, call it 0.75%, that for any given level of bank rate, the level of interest rates that will be charged to households and corporates might well be something like 0.75% higher than it might have been at that same level of bank rate if you go back just before the crisis. And the implication of that is that the central bank, the Bank of England, might want to set its own bank rate, therefore, in a new normal equilibrium about 0.75% lower than it used to settle, if that was all that was going on. Actually, there's a bit more going on than that, because for the next few years we do have some, to use a bit of jargon, fiscal headwinds, and the government trying to bring down what has been an extraordinarily large deficit. And I've done some, and I could only call them simplistic back-of-the-envelope calculations, that trying to offset the fiscal headwinds, the fact that that might reduce growth a little bit relative to what it might be in more normal times, might be offset with 75 basis points, maybe a little bit more off the level of bank rate. I'm not going to talk too much about secular stagnation, which is a phrase you hear quite a lot at the moment. I have some reasons which are elaborated a little bit in the main paper for feeling somewhat sceptical about whether that's a really big factor. But if you thought it might be worth the same amount as those other two factors, which I think we can quantify a little bit more easily, then the whole lot might add up to something like 200 or even 250 basis points. What does that mean? That means that when we get back to a more normal place, it may well be that bank rate, which we used to think of as on average about 5, might instead be on average, somewhere between perhaps 2.5 and 3. Lots of reasons to be uncertain about many of these calculations, and I think one has to be humble here and say that nobody should feel very certain about the right answer. And as always, there are unpredictable things which can have a significant impact on the appropriate monetary policy. But to my mind, if you look a few years down the road, and in our May inflation report, that was the last of our quarterly inflation reports we produced. We have another one coming out in August. In the May inflation report, the view we took as the most likely outcome for the UK economy was that we got a few years now, 3 years or so, that's our forecast horizon, 3 years of relatively normal GDP growth, round about 2.5% to 3%, somewhere in that range. And that the amount of slack or spare capacity in the UK was likely to fall to very low levels over that interval. I also believe there are reasons for thinking that some of the disruption to the supply of credit to households in the UK and companies has healed itself. Companies now say that funding from banks is more readily available and at a lower cost than it has been in the past. So there are some reasons for thinking that if that forecast turned out to be right, 3 years of relatively average growth, not much spare capacity in the UK economy, a degree of normalisation in credit conditions, one might expect one would be moving back toward a more normal level of bank rate. And a more normal level of bank rate, to my mind, might be in the vicinity of 2.5% to 3%. Now, it's interesting that if you go back a couple of months, financial markets were thinking that the level of bank rate in the middle of 2018 wouldn't be 2.5% to 3% or so, to my very crude ballpark estimate of where one might be going, but actually rather a lot lower than that at only 1.5%. Whatever one makes of that calculation, it does seem to me that the time to start normalize, what you might call the process of normalization of monetary policy, is now getting close, and certainly closer than at any time that I've been on the committee. Now, in the past, because I've not voted for rate changes and thought it was right to keep interest rates at this very low level, and because I've actually voted for even more asset purchases than we actually undertook in the bank, I was in the minority on several occasions in voting for more asset purchases. You get these labels, if you're a member of the Monetary Policy Committee, there's a dove, or for a while it was called an archdove. And so some people might think, well, hold on, what's this bloke doing now? I mean, he seems to change his view on all this. He seems to be thinking that we're quite close now to wanting to change interest rates and begin this sort of slow process of gradually moving back to a more normal level. Now, most people on the Monetary Policy Committee get slightly annoyed by these dove and hawk labels, and in some ways it's a harmless enough thing. But in some ways it's also slightly annoying because it sort of suggests you've got a genetic tendency to always want, either monetary policy needs to be tighter or monetary policy needs to be looser. And of course, somebody who had a genetic tendency in that direction would be a terrible person to have on the Monetary Policy Committee. Because what you should do, and I think what we do is just look around at what is, of course, a changing landscape and decide what the right strategy is in the light of how things have changed. And as conditions change, you change your view on what you think's right. And things have changed, I think, rather a lot in the UK economy in the past year or so. And largely for the better. And so now I think is much closer to the right time to start what you might call a gentle amble back toward a more normal setting for monetary policy. Let me conclude. 4 points. Best way to handle the risks of incurring huge costs that have been incurred from the financial crisis, I think, is to try and control leverage in the financial sector. Expecting the central bank to use interest rates to preserve financial stability, I think, is not as efficient a route as the more direct route of using capital requirements. And I don't think there's such a strong case for having monetary policy routinely directed toward preserving financial stability. And in fact, I think there's quite a strong case for thinking that an inflation targeting environment for monetary policy actually still makes sense. I don't think there actually has been a great deal of evidence that there's a risk of deflationary spirals becoming very large at low inflation rates with interest rates close to the lower bound. Perhaps because of that, I do think, and in the light of the rather good economic news we've had over the last year or so, that we now really are getting close to the time when it's appropriate to start raising rates.
I wanted to interrupt, but you finished just before I could.
Oh, sorry.
David, thank you very much. Can I just ask to just really elaborate on that last point, which you expect me to elaborate on, which is that we got a zero rate reading for inflation today. What is it about the current situation? Is it lack of, the reduction in capacity in the labour market? What is it that leads you to conclusion number 4, precisely?
I think one thing you have to do with monetary policy is think about where inflation might be down the road a bit, and not so much about where it is right now. I mean, I was on the committee in September 2011 when the inflation rate was 5.25%. And if you just reacted to where inflation is right now, if you didn't do what Peter Ustinov said, okay, then you would say, oh my God, we're 325 basis points above the inflation target. What on earth are we doing? We've bought all these assets. The balance sheet of the Bank of England is huge. And we've got the lowest bank rate in the history of the country. This is bonkers. We need to do something about this. I think that would have been a terrible mistake. And the reason it would have been a mistake then is that there were pretty good reasons for thinking that we had a temporary, substantial blip in inflation. It was likely to come back down again. And so it proved. It took a while, but there we go. Okay, we're in the opposite position now. They've undershot by 200 basis points the other way, zero inflation. And the question, I think, is, well, where do we think this is going? And I think there are some pretty good reasons for thinking that not over the next few months, 2 or 3 months, but starting from the end of this year and going through the first half of next year, it really is pretty likely that the inflation rate starts moving back up quite sharply towards the target level. And so...
But why is that? Is that because the oil price comparison drops out of the equation?
Yes.
Is it because real wages are increasing? Is it because that the capacity in the labour market, you're getting to a consensus on that? What is it?
All of the above. Okay. Everything you just said. So, the big fall in oil prices, started about a year ago. I mean, it was in the middle of 2014. We were, I forget the exact numbers, we were $120 a barrel, probably in about early June. By the time we get to early this year, you get down to 45 or something. We were around about 55 or so now. So there's been a halving in the oil price. Of course, who knows where oil prices are going, but let's just suppose you stay where you are. Never mind about bouncing back to 120, but just stay where you are in today's level of oil prices. Well, of course, then as you move toward the end of this year and into next year, the percentage change in the oil price becomes really rather small. And that will roll out of the inflation numbers. And you could say something rather similar for some other commodity price changes. And we've had a bit of an appreciation in the value of sterling, which is actually up quite a lot over the last 18 months to 2 years. There's no obvious reason for expecting that kind of appreciation in the value of sterling to just carry on indefinitely. So even if commodity prices don't bounce back but just stay where they are, and even if sterling doesn't itself reverse the appreciation, that will very likely mean that the inflation rate will start moving back toward the target. Plus, the other factors, wage increases do seem to be moving up a bit, and the amount of slack in the labour market, which I still think there's some there, but is diminishing.